had a recent article on BNC which claimed the surge of big name funders could potentially widen the gap between small and large bridging lenders, as it potentially gets a bit harder for smaller providers to grow as funding improves for their larger counterparts. So in your opinion, what impact is the growth of institutional money having on the flexibility, risk appetite, and overall offerings from the larger bridging players?
Thank you for the question. I think first it's important to define smaller lenders and larger lenders. If we're going to talk about the disparity in the lending players on the market, and how do you define a small lender? How do you define a large lender? Do you define it, by the amount of posts it puts on LinkedIn, by the amount of its funding line that it has? So, somebody has 100 million funding line, has done 10 million of loans. So I think that's important, to define. We think of ourselves as small to mid-sized lenders, but we've probably, we've done around 250 to 300 millions of loans over the last 8 years. And there's probably only a handful of lenders who have done more of that in lending volume. So, do you define it by past lending volumes? Do you define it by amount of loans currently written per quarter? Do you define it by pipeline? Do you define it by staff? So I think that's an important question. So we see ourselves as mid-sized lenders, and I think to differentiate us from the what we see as the larger lenders, within that, I would mention the challenger banks, obviously. But other than that, there's maybe, without going into specific names, there's maybe a handful of lenders that have done that volume of lending over the last 8 years. So yes, some have very large credit lines, some have a lot of staff that they've hired to develop their business. But for me, the key criteria has to be, what is your track record in actually writing loans and the volume and quantum of loans that you have written in the past and are currently writing. So that's I think, the first point. I think to your question, how does this disparity, the differences, and just stop me when you want me to stop talking, but in terms of differences between large and there's quite a few differences. I think the main one is the whole bridge market has been created and has been growing around flexibility, around pragmatism, around getting things done quickly, efficiently. And that's, I think, really what we stand for. And I think when I say we, I say all the kind of mid-sized and even the smaller lenders, to be fair. What is happening with these so-called larger lenders, and I think what you're referring to when you're saying larger lenders is lenders that have large funding lines. And lenders who have large funding lines, in a way, have become themselves almost brokers. They take a loan, they analyze it, they look at it, and then they pass it on to the credit committee of the bank, the private equity fund, etc. So just to be clear, and I think, we have these funding lines. We choose not to use them. And the reason we choose not to, or we use them sparingly and when we need, because that's really, you come back into a large bank environment, you come back in delays in processes, which is not what borrowers want from us. So I think there's a big difference. And the biggest difference is just to answer your question briefly, is the pragmatism, the flexibility that you can show as a lender when you control the deployment of capital, as opposed to these so-called larger lenders who are not in control of their destiny, really. When they write a term sheet, the borrower doesn't know that actually will get funded. Yeah. If that makes sense.
Exactly. I think I agree with you. And the how lenders are defined as large and small. I would normally say that lenders are defined as large if they've got, like you say, a big funding pockets, big funding lines, and also just their market share and the size of their loan book. I think the size of their loan book is a good kind of parameter there to measure how large they are. And you made a good point there about the more institutional, or the more they have certain types of funding lines that they can actually turn into brokers. And we had an article recently actually that claimed that the rise of forward flow funding could result in lenders at risk of turning into brokers. So I assume you agree with this statement, and how, if more lenders are kind of taking that type of approach to funding, for example, forward flow, how could this change the dynamics of the bridging market?
Yeah, absolutely. I did read that article with a lot of interest. I thought it was very interesting, and I do agree with most of what is written in the article, because at the end, when a lender writes a term sheet for a borrower, the borrower has an expectation that this has been approved, this is going to happen unless something comes up in the due diligence process, and that can always happen. But what we're seeing is that actually as a mid-sized lender funded with our own money, and I can talk a bit later about all our funding sources. But what we see very often is the so-called lenders with large funding lines. They send out a term sheet with an attractive rate sometimes, because they have cheap funding, to be fair, but it's very, very unflexible. And so many times they come to us afterwards, hey, we've got this term sheet from lender X, who at the end of the day couldn't do it. They can do it if you want to reduce the loan amount or raise the fee, etc. And this happens time and again in terms of lending. So I think the difference, if in a way with these funded large, yes, they are in a way turning to types of brokers. If that is their only funding line, then they are almost as a broker. They bring the loan to their funder. Hey, please have a look at this. Can you fund it? Yes or no? And that's where the big advantage comes of these so-called mid-size or smaller lenders who have capital available, who have, and there's a lot of liquidity in the market, and we could talk about that later as well if you want, but these are lenders that have capitals. We have money sitting in a bank account ready to go when we need it. And I think that's the big difference between, if you want, between this so-called large lenders. And again, then you got to differentiate with the banks who actually have their capital as well and who are self-funded. So that's a different animal altogether. But if you talk about lenders who are funded by, institutional investment banks or private equity houses, I think that is the difference. They are a type of glorified broker in a way.
Mm. You also made a comment earlier that that institutional funding is available to you. You just choose not to utilize that. Do you agree that smaller bridging lenders will struggle to secure institutional funding going forward, or as there's so much choice for funders, there's so many lenders in the market, or do you think that there is an opportunity for them to get institutional funding if they wish to have it?
Yeah. So just to clarify the point, we have an institutional kind of credit line. We work well with our lenders. The point I was trying to make is you can't be only dependent on that, on this funding, because if you're only dependent on your funding line, you end up to be able to disappoint a lot of your borrowers and a lot of the brokers you work with, because there's no certainty of execution if you are based only on the funding line. So that's just that point. I think from my experience, and we talk to funders all the time, there is generally a lot of liquidity in the market. Banks are almost, it's costing them money on their balance sheet to hold that money. So everybody's desperate to get money out. From our experience, all kind of types of funders at the end of the day will do the same type of due diligence. They want to see that you have experience. They want to see that you've gone through a cycle. In that sense, COVID was very interesting, and I can talk about that later as well. They want to see that you got a good track record, a good team in place. You know what you're doing. What has been your track record in terms of defaults? What has been your track record in terms of what you've done? So in that sense, I think if you have that, I think there is funding available. You need a bit more structure around your business if you want an institutional funding line. So I think some of these smaller or family offices or 2-3 man shows who do very good work, to be honest, on the lending side, they may struggle to access institutional funding. So I think you need a bit more bells around the whistle if you want to access that kind of funding. But it's certainly available and out there, and it's cheap, and it's a lot cheaper than high net worth funding, or we have a fund as well where we return high returns and that. It's cheap, but it's not flexible.
And this kind of race to the bottom on rates has been debated often over the last year or so, where brokers are even saying rate isn't the most important thing. While the borrower might think that is, the brokers are having to kind of educate their clients to say that actually you know, goalposts can be moved because of inflexibility and also the kind of the lenders that they trust might not be the cheapest. So there's that argument as well. I understand that Whitehall is self-funded, and also you leverage capital from, as you said, high net worth individuals, family offices, and hedge funds, which is historically how the majority of the bridging market was funded. Do you expect to see a return to this type of backing, or do you think the market will continue to be further institutionalized?
So I just want to clarify on our funding structure and line, because it's relevant to answer your question. And we, whilst the ultimate investors are family offices and funds and high net worth, we are quite unique in that we have a fund that is a pool of money that we have already raised, sitting there waiting to be deployed. So yes, the ultimate owners are family offices, some funds, etc. But we are quite different in that we're not the typical family. How does a typical family office operate? If they see an interesting loan, it's paying whatever, 8, 9, 10% a year. They call their high net worth, hey, would you like to do this loan? And then they get funded. Well, that's also how the peer-to-peer market operates. So in that sense, again, I think we have a bit of benefit in that we have that pot of permanent money that is already sitting there. And at the end of the day, we have discretion over that money. So we will decide. That again allows us to move in a fast, efficient way, and also stand behind the term sheets that we write, because we know we will be able to execute. So that's just the first thing. I think to answer your question, you know, are we going back to high net worth fund? I think they always have been there. You know, I remember I was pitching our fund to some high net worth who's, you know, it told me, Anthony, you know, 20 years ago, I wouldn't do this less than 2% a month. I used to do this. So they've always been doing that. I think opportunistically, investors are looking for assets to deploy their capital in. Interest rate environment is very conducive to that. Other asset prices, other asset classes have, you know, had quite a bit of a run. So I think all sorts of capital is interested. As an asset class, it's hard to beat with its risk reward profile. At the end of the day, we return roughly, you know, 2.5% a quarter, 8-10% net per annum, with almost no volatility. We've, touch wood, have had no defaults. So which other asset class can you get that to? So to answer your question, I think high net worths have always been funding these type of deals. They will continue to look for it. I think in a way, I'm a little bit, if there is a concern, it's actually the institutional funding coming in. Because what you see with institutional funders, they come with, and that's all in our discussion with funders. I always, hey, we want to give you 100 million, we want to give you 150 million. And I'm like, okay, can we take 30? Can we take 50 and build it up? Because I think that's where you go wrong. When there's too much capital on the market, people are under pressure to write loans. And that's a risk, because then you have lending standards who are starting to weaken, and there is that pressure, hey, we've paid the fees on this facility, we need to put the money to work. So I think I'm not so much concerned about the high net worths. I'm more concerned about institutional funders, and also that capital is very, very, you know, it comes and goes very quickly. And if I can talk a second about what happened during COVID, for example, which, so our first, the first quarter when the UK went into lockdown, which was March of last year, we had our best quarter since we started 9 years ago. Why? Because all of these so-called institutional lenders who were desperate to get into the lending market from one day to the next, completely stopped lending. And it took them a lot of, and that's where borrowers need us. You know, we are not cheap. The bridge market in general is more expensive than bank debt. If you can get bank debt and you can take your time, you can get funded at 3, 4, 5% per annum. But you got to be there when they need you. And I think, again, this is where this independent funding model really shows its strength. That was our quarter where we wrote the most loans, but also at the highest rates. There was no one on the market. All these PE funds and investment banks, hey, we stop everything. There's some order from New York. A lot of them are funded from abroad. US investment banks have been very aggressive against the market. Some European investment banks we have been calls with as well. And I think they get instruction from above, hey, we need to deploy 100 million into that market. How quickly can you do it for us? And that's dangerous. That worries me a little bit.
The you made a good point there about the amount of funding that institutional funders are providing lenders. You know, say like 100 million, for example, and you might be looking at the smaller amount to kind of build it up. And do you think there's a concern that the amount of liquidity in the market, the amount of institutional funding in the market, is not keeping pace with the actual amount of business that's available?
So I think the quantum of money available in itself should not be a problem. What is a problem is the pressure it puts on lenders, the pressure it puts on investment banks to, you know, just get money out of the door at whatever cost, and having lending standards weaken. So I think that is the risk. And the risk is that this money is not actually very sticky, this institution money, because very, you know, as we saw during the current pandemic, you know, from one day to the next, funding stopped, almost dried up completely. And I think almost the larger you were as a lender at the time, and the more you were dependent on these lines, the longer it took you to be able to start lending again. You know, we closed the office on a Monday evening. On a Tuesday morning, we were all working from home, doing what we had to do, and we could do that because, you know, we 10, 12 people, and we can make that happen. If you have just hired 20 new people who, you know, need to kind of understand the market, a lot of the new lenders with these large funding lines are relatively new to the market. You didn't, as you said, prior to that, you had, you know, mainly kind of high net worth family office, or you had the challenger banks or some private equity funds. This model of having a large funder, and I get the model makes a lot of sense economically, don't get me wrong. I understand why they're doing it. I think there are just some risks associated with that.
Yeah, and also, you know, the fees that they have to pay to hold to take that that funding, and if they don't get it out the door, like you say, quick enough, they're paying for it. And there could be that, you know, that risk that there could potentially be risky lending decisions because of the pressure, like you say. So that
absolutely, yeah. Absolutely. We actually, from experience now, we insist on, and on a current funding line, we have what is called non-utilization fee, i.e. a fee you pay when you're not using the capital. And I think that's where the conflict arises between a lender and an investment bank or a funder or a private equity player. Because the funder gives you that line, you're paying him a certain fee. Now, if you do nothing, he still gets his fee. And so there is that constant friction, I think, between the funder and the lender in that sense. So we actually try, it's not always possible, but we have that in our current funding arrangements, to have no non-utilization fee, exactly to avoid that pressure. We don't want to be writing loans that we're not 100% comfortable with them. At the end of the day, you know, investors trust us to look after their money. We have done that, and we plan to continue to do that. And it's not about size, because we are self-funded, because we are independent. We don't have to have a $1 billion loan book. I actually don't believe it's possible to run a $1 billion loan book with that amount of volatility and that type of return. So returning your double-digit returns with that level of volatility is just not possible to do with a $1 billion loan book. Again, just to come back to COVID. When COVID came, I was personally on the phone with every borrower, talking to them, understanding the situation, making arrangements where necessary, and as a result, you know, we could manage it. If you have thousands of borrowers, it's just not physically possible to do that. So I think, you know, the reason we're talking is I think there is definitely a place for mid-sized lenders and smaller lenders. I think that's what the essence of the market is about, more than anything else.
Yeah. And you also mentioned there about how in the previous question about how when funders kind of retracted their lines when COVID struck, that was at the time when borrowers needed the money the most. So do you think that smaller bridging lenders will have an advantage to larger lenders as we come out of the pandemic, because they will need to cater to changing borrower requirements and more complex needs than they would have had before?
So interesting enough, I would argue the opposite almost. I would argue that during COVID, I'm talking from my own experience here, we had generally one of our best years because all the other lenders weren't there. So we continue to do work as normal. What is happening, certainly at the beginning of the year, is that suddenly they realize, hey, actually the world's not collapsing, things will improve, something we realized a long time ago, but it took time to go through their structures, through their management structures, etc. And what happened is that really they're almost trying to play catch up and sending even more money to the market, and that has put some pressure on rates, some pressure on, but not only on rates, also on lending standards and underwriting standards, which is the key here. You know, how to look at that loan and not just to get money out of the door to get it out of the door. So I would argue actually when the market is buoyant as it is now, and generally it is very, very busy for us and I'm sure for all other lenders. Yes, they can have funding that is a bit cheaper, and that makes it a bit difficult for a mid-sized lender whose cost of capital is slightly higher. So in that sense, I think you know, I think when it's available and everybody wants to lend, they may have the upper hand. But we are there when they need us. And what I do want to say is, even in this strong market, we get at least once every 2 weeks a borrower coming to us, hey, we got this term sheet from this lender who's funded by a third party and they pulled out. So they send us a term sheet. And what's happened is very clear to everybody. They thought they could write a loan, but then went to their funder who said, hey, there's a limit. And some of them, and some are better than others, but some are very restrictive in their lending criteria. And then they come to us. So yeah, I think that's a big situation currently.
When you say there's a restriction, do you mean that there's a restriction from their funding line in terms of how much they can lend, or was it that the goalpost moved in terms of they weren't happy with the criteria of that case?
I don't think they moved, because from our experience, most funders are very detailed in terms of their term sheets and their legal agreements into what they will allow to lend against. I think they're just restrictive in their terms. You know, we have one lender, we know of one lender who has a funding line that won't allow above £1 million, so £1 million. So it has to be below £1 million. Anything above £1 million, they can't do. So it's £1,050,000, they're out. Some lenders, I've seen everything. You know, some funders want only residential, some funders want only the southeast, some want only London, some want only a certain type of asset class. So I mean, the restrictions more in that. I don't think, or I haven't seen that they move the goalposts after signing. I think they're just restrictive to start with.
If that's the case, then why are they putting out terms if they know that their funding lines wouldn't accept that sort of business?
Yeah, no, I think very often they don't. Again, I can only talk also about our own experience. Very often we have a loan that we are pretty sure that our funders will want to fund, and for whatever reason they don't. So I don't think they would do that purposefully, because they have no interest in wasting anybody's time. I'd assume, at least the respected lenders. So I think they generally hope, but the process is different, and that's the whole point. Like you don't have that certainty. You know that if your own credit committee, the guy sitting in the office next door to you, sitting and make a decision, you can make the loan. We know we can make. They don't know that. If you go to this investment bank or this PE firm or whatever, you have no certainty. So I think they expect the loan to pass. It just doesn't, for whatever reason. And there's many reasons. They don't like the borrower, they don't like the asset. There's many reasons for funders to reject loans, really.
Yeah, and that is something which historically brokers have really appreciated, to be able to have the direct phone number of the person who actually makes the decision. So the principle of a lender, and that to them is worth their weight in gold, to be able to say to a client, I will definitely be able to get this loan for you because I've spoken to the decision maker. Whereas if they're speaking to a much larger bridging lender who's funded by quite a restrictive institutional funding line, they won't be able to talk to their credit committee. It will just be someone who they've got a connection with at the lender. So there's another chain. So that's a really interesting point, and I think that will become more important going forward. You've mentioned obviously a lot of the benefits that smaller and mid-sized bridging lenders have in terms of how they're funded, but what challenges do you expect smaller or mid-sized bridging lenders to face over the next 12 months?
So I think, first of all, they face the normal kind of market challenges like everybody else. At the end of the day, we're all lending against assets. If these assets go, for whatever reason, in the wrong direction too extremely, because again, we're not really exposed directly to the equity in property, but we are exposed indirectly to the value of our collateral, of our loans. So that's one challenge. We can talk about that a bit more in length, but just in a sentence, markets, there is a lot of liquidity in the markets. Asset prices are very high. That goes for property prices as well. So that's a market risk, I think, that we have like everybody else. Specifically to mid-sized lenders, and I think here the difference is a lot of the, and I'm talking about a lot of these new lenders that have popped up recently who are supposedly larger, they've raised a lot of money to put into the business. So there's an advantage and a disadvantage to that. The advantage is they have capital to deploy. The disadvantage is down the massive pressure to deliver, to write loans, which is not always a good thing. So I would say for us, it's always a technologies, and I know we were supposed to talk a little bit about that, but the only thing I will say about investing in technology is a challenge, is more a challenge for me. And one of the things we're looking is to significantly upgrade our systems and the way we monitor loans, etc. And we spend quite a bit of time doing market research at that. So I think that is easier when you are either have raised a lot of equity within your business, or you generally have a very large loan book and generally have very high volume numbers to go through that process. Because some of the systems, none of them is perfect from our research in a sentence. So you kind of have to go a bit tailor-made, and that's not cheap. So I think that is an advanced scale is an advantage that we don't have, or smaller lenders don't have. I like to think that we have that capability. So that's one thing. I think for the rest, pricing, we spoke about that. They've cheaper access to funding. That is a challenge when in a market that is very active and where everybody wants to lend. So that's a challenge as well. And I think for the rest, it's mainly benefit. And you touched upon one very important one, which is being able to pick up the phone to me, to my partners, and get a direct and clear answer. I think that's one of the big benefits. The challenges are, I would say, really, investment in technology, investment in general in the business for the smaller lenders, and then cost of funding is also a disadvantage in a strong market.
Great, thanks for that. And then finally, with this kind of gap widening between the small and large lenders, there's clearly an opportunity here for mid-sized bridging lenders like yours. So and also many brokers are saying they would rather bridging lenders avoid this race to the bottom on rates and actually create something that's different, so new offerings in that mid space. So will you be bringing anything out, or are you specializing in anything this year or over the next 12 months that is something that's going to be different to the market?
I think that's a very good point. And I think here again, I think our main strength is the pragmatism that we can show in cases that we look at. So, the products we offer, at the end of the day, they've got a lot of names. Our focus is really on the bridging side. We try and do as many bridge loans and really help our clients, to give that money within 4 or 5 days when they need it. And I think brokers hugely appreciate that we deliver. So I think, that's our focus. We've been growing our development business as well. We have at the end of the day, we kind of believe in keeping it simple and doing what we do in a good way. And I think that in itself is a challenge. I think we've proven with the feedback we're getting from brokers, from borrowers directly. We just try and make it as easy as possible for our borrowers to work on, to always keep in mind, my background is in large banks as well. And it's one of the reasons I left these large banks, because it was impossible to get anything done. So that's kind of really where our focus lies. We continue to do, bridges, development financing, We have no major to invest in technology. We're doing that a lot, but nothing other than that for now.